rare. Hello, everyone. Welcome to another webinar from HFM. Andria Behidi over here. I think you already know me, or the most of you. It's been years. This relationship is going on for a decade nearly. So today we're going to go through a divergence, so trading divergence. It's a topic that I choose to do once a year, once every 2 years, occasionally touch it if I found it in front of me in the charts. But because it's something that is not easy to be spotted, even though it's very, very powerful, I choose to do it, as I said, once every year. So don't worry regarding the recording. For everyone that cannot stay until the very end, you're going to receive your recording after we are done in the email, in your email. Lately, we were having a lot of difficulties with the email service. I know that some of you might have not received an email from us for a while. As the technicians inform me, they have managed to sort it out. So hopefully, you're gonna receive the recordings from now onwards. But anyway, remember that the recordings are in our YouTube channel, so feel free to ask for them or visit our YouTube channel and try to find any webinar that interests you. So divergence today. Before I move on, as usual, we need to go through the disclaimer warning. Okay, this material provides as a general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk, for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved. Take into account your investment objective and level of experience before trading, and if necessary, seek independent advice. Webinars@hfm.com, our email address, as already is widely known. I'm gonna skip my intro and let's go straight to the topic, because today is a very important day ahead. So I would like to close the webinar on time, because as you already know, guys, we're gonna host a live streaming in all our social media for the US inflation and ahead of the FOMC meeting and press conference later on today. So don't hesitate to join us in a live commentary going through the data and explaining what might happen tonight. So what we're gonna cover today, we're gonna cover obviously what is divergence and the two types of divergence that we have, how you can trade using divergence if of course you spot one, what's the hidden divergence and how can be spotted, double divergence, something that I forgot to mention over here, and of course feel free to ask me anything you want. First of all, let's go through the vocabulary, because I don't know how many of you are new over here, the level of expertise in the financial markets, and especially in the online trading and etc. So by oscillator, we mean any single indicator that oscillates or moves ups and down with price. We have plenty. That's just 4 examples: stochastics, RSI, MFI, MACD. So the indicators, oscillators actually, they don't only oscillate based on the price movement, but also they measure and indicate to the traders and to the investors the momentum. What momentum is? Momentum, what is it? Basically, is the strength of a move. So if price is moving fast over a short period of time, then that indicates that momentum is strong. If momentum, if the price movement slows down, it means that the momentum slows down as well. So the move might not be as strong as it seemed. So it might run out of steam soon, or it might change its direction. Sorry. Divergence. Now this is where I want to focus on. Basically, okay. Divergence. Regardless of online trading, investing, etc., divergence as a word, right? What it means when something is moving in a different direction to something else, right? If we have A and B, and these two things, cars, whatever you want to call it, move in the exact opposite directions, we say that they diverge, right? So the concept is pretty much the same. So divergence in the Forex market, commodity market, and etc., is when the price of an asset is moving in the opposite exact direction of a technical indicator, such as oscillator. That's why I explained earlier the meaning of oscillator. So what is a divergence in our industry? Divergence warns the investors, warns the traders that the current price, okay, the current price direction, the current price trend may be weakening. So in some cases may lead to price changing direction in the near future. Okay, we're gonna go through it everything in a bit, don't worry about it. We have though two types of divergence, positive and negative. So what we mean by positive and what would mean by negative? Positive divergence indicates a move higher in the price of the asset. Okay, so it suggests that the price might start moving higher. Okay, negative divergence indicates that the asset might move lower. The price of the asset might move lower. Oops. Okay. So let's see a bit of the illustration of what I just explained, the divergence, and in this case, the negative divergence first. Okay. So this is, imagine that this is the price of an asset, fluctuates but rising slowly, right? While the indicator that we are using, oscillator, is fluctuating as well, but mainly moving lower and lower. Slow, with some baby steps, but lower. So What that means, what if the two parameters that we have, the price and the oscillator, are negatively diverge negatively, sorry. That basically, this is a negative signal for the asset, okay? So that suggests that we should be very careful, because this uptrend might run out of steam and start a downtrend, so that we might have a reversal sooner or later. Okay, how, first of all, before we check closer, have a closer look on how we can identify when that reversal will happen, let's see how you can spot a divergence. Basically, by connecting the highs of your asset, so the highs, the high prices with a line, the high prices of your asset, okay, connecting them with a line, and by connecting the peaks of the oscillator, okay, again with a line, and then compare to see, to check what direction each of those two parameters show. So price, by connecting the highs, if the trend line shows upwards, that means that we are in an uptrend, obviously. By connecting the highs of the oscillator, if we saw that the line is pointing downwards, this is when we claim that this is a negative divergence. Okay? And as I said, a negative divergence indicates that sooner or later we might see the asset starting a new trend, and this time a downtrend. But be very, very careful. It's not a signal that, so it's not like an entry point. If you spot a divergence, it's not calling for action. It's not calling you to enter the market. Okay? Do keep in mind that divergence is just ahead of time signal. So what we need to do is just start monitoring the asset, okay? Be careful and start monitoring the asset to in order to spot when actually the reversal might happen. Okay, so first of all, some tips for trading diversions, let's say, is be aware of the general trend, right? Draw key trend lines, key support lines, key resistance lines. This is a positive divergence, by the way. And once you spot the divergence, define what it is indicating, okay? For example, if it's a negative divergence, you can also hear it as bearish divergence. This will suggest that the asset, as I said, is about to see reversal and decline. So then, once you have done all these 3 steps, you need to wait for your strategy to give you an appropriate entry signal. If, for example, you have a breakout strategy, then you're waiting for the breakout. If you are a price action trader, then spot the support levels and wait for a breakout of the support level. If you have spotted a pattern, then you need to wait in general for a confirmation, for an appropriate entry signal based on your strategy. So you apply your strategy, wait. This is the divergence. With the divergence, you need to wait, because it might happen, it might not happen. But if it happens, it's a very, very, very strong signal, well ahead of time. Okay, so that means that it gives you the time to enter from the beginning. Okay, so let's go through the positive divergence is the exact opposite concept, connecting the lows in both price and oscillators. If you see that they diverge, if the price is pointing down, okay, the trend line by connecting the bottom of the price movement is pointing downwards, while by connecting the bottoms of the oscillator, it points upwards. That's a positive divergence, otherwise called as bullish divergence. And you know that we might see a reversal to the upside. We might see an uptrend. We might see a reversal, a rebound, if you want to call it that way. Okay. So just to add, as I said earlier, this is just a signal. It's not a call to action. You shouldn't enter the market. You need to wait for a confirmation. You need to apply your strategy and wait for your strategy to give you an appropriate entry signal. So spotting the divergence, as you can see, it looks a bit simple, right? But is the confirmation that is the tricky thing. Confirmation is occurring when the indicator is moving in the same direction as the price, or if you have the breakout that I mentioned earlier. Rising prices are accompanied by an indicator that is moving higher too, right? So the confirmation to entering might come from your indicators. Depends if you use indicators or not. Okay, so let's move on. Anyway, we have plenty of examples later on. This is everything that I already mentioned verbally. Divergence is an indication of a possible trend reversal ahead of time, not a certain entry signal. It's just a very, very, very prime signal that you might see a new trend developing soon. So you need to do your homework, apply your strategy, and wait for a possible entry in the opposite direction of the trend. Like in general, what you should do, I mean, not only when you're trading divergence, in general, every morning, you need to scan your markets, spot overall trends, the direction of each market, right? This is the basics. And secondary, to study what the indicators are telling you for that particular asset. And if you have spotted a divergence, then you need to monitor, apply your strategy, and wait for a signal. Okay? As I said, sometimes until divergence spotted, reversal might already occur. So be careful. Spot support level, so spot the resistance level, put some trend lines on in order to be well aware where your price action stands. Here is an example, a very old one, but it's a very nice example that's why I'm keeping it. Well, I had a clear uptrend in a daily time frame for pound Swiss. I start checking the tops of the stochastic over here. I couldn't spot anything weird. Then I connect these three, and I saw that there is a bit of a decline, slight, very, very narrow one, but a decline. So this is the stochastic was doing lower highs, but the price for that particular time period, right? Because the time periods should be the same, was moving higher. So that that raises a question. Is this a divergence? Is this not a divergence? So what you need to do in this scenario, right? You can either use, if you're using moving average, you can use your moving average as your breakout points and say, okay, if it breaks, if the asset breaks below the 20-day moving average, then this is calling for a short entry because of the negative indication that I have over here for divergence. So that will call for a decline, which actually happened, as you can see over here. Or if you're not using moving averages, indicators, etc., you can connect the bottom points, the lower points of your price action in order to spot a breakout, because this is a support, right? And let me clear a bit this mess. Okay. So possible entry can be taken once trend lines breaks downwards. Okay, so that was a clear indication of a breakdown, massive breakdown, actually very strong one, which indicated that we have a downtrend. And how you can time your downtrend? By, again, monitoring the lower highs and lower lows and the indicators. So the indicators started posting lower highs, lower highs, lower highs, until it broke in this trend line and extended above 20. So that was a warning that maybe you should consider closing your position, take profit basically. Okay, so you can use your indicator again for timing your entry. So let's move on. Again and again, very, very important. Divergence can be used only for giving clues of a new trend. Okay, it does not indicate when you should enter the market or a possible stop loss or a target level. Use your strategy for all of this. As I said, some possible entry levels, but each one of you know that you have your own strategy. So don't take this for granted, okay? But I mean, if you have your own strategy on how to spot an entry point and etc., use that. But for anyone that just to help people, consider that possible entry points could be a breakout of a trend line, like I did over here. I tried to show you over here basically, or a breakout of moving average is if the asset is well supported by moving average, or you can go down to a shorter time frame. So here we are in a 4-hour chart. You can go down to the 4-hour chart or even 1-hour chart, not more than 2 scales down, and see how the asset performs over there, whether a decline has already started or not, and etc., in order to help you identify an entry point. This is a bullish example, okay? We had been in a downtrend, okay? By connecting the lows, in both price action and the stochastic, I spotted the stochastic started pointing slightly higher, okay? Not something very, very convincing, not something convincing, maybe clearly, but why not be ahead of time and get prepared? So in this case, by connecting the highs again with the trend line, or simply by using the 20-day moving average, as you can see, it coincides very well with my trend line. If you connected the highs, you will see that there was a confluence. So a break above the 20-day moving average or the trend line, that could be your next entry point for a long position, right? for the dollar CAD daily chart. This is the same example, dollar CAD, but I went 2 scales down to the 1-hour chart to show you how you can spot your possible entry with this way. One way will be the trend line or the 20-day moving average and etc. Another way is to go down maximum 2 scales down, okay, and spot possible entries. As you can see here, it was a decline, right? The stochastic started improving, right? Oh, I cannot. Started improving. I think it's clearer if I don't draw the line. But as you can see, this is higher than this, and this is higher than this, okay? So that was an indication, let's say, that maybe this sharp downtrend might run out of steam. But that's it, or is it just correcting? So we weren't really sure whether this is a correction or not, okay? But the immediate resistance level was over here, okay? Because over here, the asset struggled to extend higher. We had consecutive highs, and that was our very, very first resistance area. So a breakout of that level could trigger an entry point. Indeed, the breakout came over here with a very decisive 1-hour candle, and that was a possible entry point that lasted just for a few hours. But why not? Profit is a profit afterward, right? After sorry. Okay, corrected again lower. So you can use shorter time frames if you want to trade, if you are an intraday trader anyway, but if you want even to trade these small intraday short-lived fluctuations, okay? So afterwards, again down, retested the bottom, right? But didn't break it. Held, right? And try to recover again. Okay, I wouldn't call that a possible entry point, really. It was a bit, it is a possible entry point, but you need to have a stop loss down here or lower over here, just to keep you in the market, even if we see the asset struggling to extend higher. Okay, so I know that the possible entry 1 and possible entry 2 and even possible entry 3 are looking like weak entry points. But if you have place an appropriate stop loss or trailing stop just to lock some profits, that will keep you in the market, okay? So use trend lines, use previous highs, latest swing highs to spot your next possible entries if and only if you're using 1-hour chart or shorter time frames for spotting your entry level. Okay, there is another type of divergence which is called hidden. Okay, hidden divergence is the opposite of regular divergence in forex trading and actually suggests that the asset will not reverse, but basically it will continue in the same direction. Okay, and still again we have the hidden bullish divergence and hidden bearish divergence. So extended divergence, sorry, not the extended divergence, a bit more advanced one. So hidden divergence, as I said, it doesn't signal the reversal, it signals that the market will continue in the same direction. Okay, so it's again an alert that traders should have should search for a possible entry, but in the same direction, not in the opposite direction. The steps are the same. Spot, first identify the direction of the market, then the direction of the indicator. And then you're gonna figure out whether you have divergence, normal line divergence, regular divergence, or hidden divergence, and what kind of divergence you will have, bullish or bearish, etc. So yeah, let's move on. Okay, here it's just a nice design, let's say, that simplifies a bit these two concepts. Sorry. So yeah, this is the indicator, this is the price, okay, just for you to remember what is what and to comprehend these two concepts and the difference between the regular and the hidden. So in the hidden, we have, if the price goes down, if by connecting, okay, you see, connecting the highs of the price and the highs of the oscillator, okay, and we are seeing that the price moves down, but the oscillators goes up, okay, this is again a bearish hidden divergence. What that means, it means that we have strong momentum downwards. So it means that it will continue moving lower. And here what it means, we have bullish hidden divergence. Why? The asset is moving up, the momentum is moving down, so it's getting weaker and weaker. So weak divergence, okay, weaker divergence. Again, sorry, I can hear the noise outside, and I'm a bit confused. Yeah, hidden bullish divergence is when the pair is in an uptrend like this one. The price is making higher lows like this one, but the indicator is posting lower lows at the same time. So this could signal a continuation of the uptrend. The only way to find out is by waiting for a confirmation, okay? While, again, I'm going to explain the bearish hidden divergence. Hidden bearish divergence is when the price moves down, the momentum moves up, right? So this signal that the downtrend is likely to resume, to continue. Let's see some examples. Pound yen 1 hour chart, clearly uptrend, right? Clear uptrend. At the same time, by connecting the lows, I could see that it's moving downwards. So down, up. So that suggests that we might see, remember, the difference is where you're placing your trend lines, right? We have higher highs, we have higher lows, we have lower lows and steady highs. So the lower bottoms in our momentum indicator, okay, along with the indicators posting lower lows at the same time that the price is making higher lows, that suggests that the uptrend might continue. How you can confirm that? If you continue to see right at higher lows, then that is the confirmation for something like that. So with these conditions, if you spot something like that, you need to go along with the trend. Remember, the trend is our friend. And here is how you can spot a possible entry levels in order to participate the trend. Remember, this is our chart. I told you that you can go up the maximum 2 scales down. You don't have to go 2 scales down necessarily. You can go just 1. The maximum though is 2. So go down to the 30 minutes chart, right? You have spotted, as we said, higher lows in the price. That was the line that I had from the 1 hour chart, and it's when we have spotted lower lows or the indicator. So how you can spot, how you can participate on the trend if and only if you have identified and confirmed that it will continue to the upside by drawing, spotting or drawing the latest resistance level. So the latest resistance level was obviously here. So if the asset extends higher, breaking the latest resistance, that would be a possible entry point. If you miss that, wait for confirmation, wait for further move to the upside and a breakout of a key resistance level. So here we have the second one, here we have the third one, because it broken upwards the previous latest highs. Okay, that's just one way to do it. Depends on your strategy. Example on the bearish hidden divergence, the asset keeps moving lower and lower, lower highs, lower lows, but the indicator is posting higher highs. Okay, so momentum is strong to this downtrend. Okay, the momentum indicates strong downtrend. A strong downtrend, it means that is likely to continue. And here it is what happened, which indeed moved further to the downside. Entry point, again, what is our latest after spotting the divergence? What is our latest support level in this downtrend? This one. Consolidated for a while above this support, failed to break it until this happened here. Okay, that's why you need to wisely use and spot your stop loss. This is a clear short entry over here with the stop loss at the previous high, so here. So even if the asset, if the bulls try to correct the price action, the stop loss, which if it was wisely used at the latest top, will have kept you in the market and you will have benefit this move. Okay, also how to time your entry, remember, again, by either monitoring the price action or monitoring as well the momentum. Here we have a bottom, right? And we started seeing higher bottoms in the stochastic, in the MACD, sorry. So that could trigger the attention either to close the position or partially close the position. Okay, that's a briefing, but I want, it's already 2:40 and we have 20 minutes to go until the live. So I will, I have more examples over here, guys, but I would like, because there is not enough time, would like to go straight to the to the double divergence, and you can spend your free time study these examples that I haven't, we haven't had the chance to go through them today. So like, this is just examples with other indicators, not only stochastic. You can use RSI, you can use MACD. Just try to keep one, not many indicators, one indicator. Just plenty of examples here. Here we spotted a triangle. Actually looks like a pennant, to be honest, an ascending triangle. So the breakout of the triangle downwards, which was also in happened after we had in mind this divergence, lower peaks in the MACD, but at the same time higher higher highs in the price action. So that's a negative divergence. And yes, indeed, it happened. It broken, consolidated a bit, and and indeed it continued downwards. Basically, here was down, broken the ascending triangle, small baby steps, slowly downwards until we had another shift to the downside. So let's quickly, please. Sorry for that, but inflation is very important today, and it's NFP as well. Sorry, it's the Fed as well today. So I'm gonna go through the double divergence before I call it a date. Every single trader who has, let's say, traded divergence, okay, knows that the prediction value of the divergence alone is oftentimes not very high, and especially during established trends, divergences are not a reliable sign of a price reversal. Okay, that's why we need the confirmation. So that's when the double divergence comes in. A double divergence occurs when a series of multiple higher price or lower lows, in this case, when we have multiple higher highs in the price or lower lows in the price, such as in this example, 1, 2, 3, 4, etc. So when we have multiple ones, is when we have the double divergence. So we have multiple, in this case, lower lows, while the indicator prints multiple higher lows. Okay, this is what we call multiple. So in this example, we are using the MACD indicator. This is MACD. You can use RSI, by the way, it doesn't matter. It's just the momentum indicator that you like, that you tend to use. So this is a clear double divergence during a downtrend. Okay. So looking at the price, okay, it shows that the trend waves, sorry, that the trend waves is 1, 2, 3, 4 waves actually, are becoming shallower and less strong, right? So look at that. This is less strong than this one. And this is way less strong than this sharp one. Let me clear the mess. Okay, so this means that the price cannot as easily push lower, and each trend wave is weaker. So MACD in this case shows multiple light divergence, right? But just going with the first divergence alone will be a losing system. So a patient trader in this case if you spot something like that, if you spot divergence but weaker waves of divergence and multiple divergence, then a patient trader will wait for the next wave to see how strong it is before he decides to participate in the trend. Also, it is advisable to wait until the price makes a new higher high, which will be a signal for a trend shift, and you can enter instead the reversal instead of enter the continuation of the trend. That's another example. You see, a bit shallow, sharp, so that's a nice level to enter because it's double divergence, 1, 2, 1, 2, convergence over here, but a sharper one. So so it means that it's not shallow, so it means that it's still strong, and you can still participate because there is still enough steam to the downside. But if for any reason the waves get shallow and shallower and shallower, then you might consider waiting a bit and actually wait for a reversal. This screenshot, as you can see, is again another example of that double divergence. So we have a normal, regular, single divergence, but the price did not reverse and kept on going lower, right? With this second one. Then the MACD confirmed the downtrend once again and posted lower lows over here. Okay, so that was a convergence in clearly stating that the downtrend is still here and it will continue. And then, even though we had sharp waves lower, the indicator started posting divergence, double one again. So that was when the market that shows that the market reversed higher. So trading a single divergence on its own does provide less accuracy compared to a double divergence. Okay, of course, sometimes a single divergence will cause a trend reversal already, but wait for double divergence because it could increase the trade quality. So this last example shows how important is a double divergence. And it is also apparent that the price action is becoming increasingly weaker. The price candles and trend waves are leading lower, as you can see. But as we breach the bottom of the trend, they started to get shorter and not as strong as before. And at the very bottom here, the price also printed a pin bar. Pin bar, have you noticed the pin bar? Which is generally considered as a reversal signal, if it occurs in the right context, of course. More and more examples. That's a situation where I can see a clear divergence in a bullish trend. So basically the lines that you are seeing is just by connecting different highs, okay, but still getting the same message, divergence, a negative divergence. Then indeed the market goes a bit sideways, so there is a delay on the actual reversal. That's why you need to be patient when you spot a divergence. That was also a negative signal for the short-lived pullback. But the reversal, clear reversal of the uptrend, it came over here. So it's the same example, but indicating to you how you can trade this evening star formation until the bottom of the ranging market in which the asset entered. And then you could add it on your existing position or open a new one if you have closed the previous on the breakout outside the ranging market with the targets down to 260 Fibonacci extension, 200 Fibonacci extension, or the 61.8 Fibonacci level on this uptrend, on the earlier big uptrend, on the overall uptrend. Guys, unfortunately, I need to call it a date. The recording will be available soon. I need to go straight to get prepared for the live analysis. Join me over there as well, YouTube, Facebook, LinkedIn, Twitter, and etc. Because soonish we're gonna have out the inflation, which is the most important along actually the whole day is crucial because it's a double risk event. We have inflation, we have the Fed tonight, so we wait and see whether this will surprise us. Anything out of these two events could surprise the market, because the markets are wait and see stand since Monday, exactly because these two events are the most important of the month, I will say. Okay, sorry for calling it short. I have to go through the slides. Anything you need, I'm here to help. Just send me an email at webinars@edgefm.com and I will help you if you're struggling with any of these slides. Thank you. Have a great day ahead. Bye-bye.